Hey Bowtie Nation, Joseph Hogue here with another one of our quick news-related videos. All the news that really catches my attention, stock ideas that aren't yet priced into the market. So putting two and two together, one of my favorite strategies here, folks. Today we're going to be highlighting a potential acquisition target that could see one of the cybersecurity stocks I follow jump 70%, and why SoFi Technologies is having so much trouble staying above this $22, $23 per share price. We see it is up pretty strong today, but every time it's hit that $22, $23, even $21 share price, it's fallen back down, giving back some of that. So some really interesting ideas there. Really like that cybersecurity stock for the potential for that acquisition and what could be up to a 70% bump there. If you like these kinds of news-related videos, let me know in the comments. Give the video a quick thumbs up. First though, nation, all the stock picks in the world aren't going to mean a damn thing if they're not the right stocks for your goals. So if you haven't yet signed up for the one-on-one portfolio analysis, make sure you look for the link in the description below. This is going to be part of a research project I'm doing to understand investor behaviors and help you invest better. If you are interested, use the link I'll leave in the description to learn more there. On that page, you're going to share your investments if you bought and sold over the last 3 years or however much data you've got there, along with your goals and your risk level. With that, we're going to be able to see if your actual investments match your goals. If you're selling too early, too late, I'm going to personally review your investing strategy along with the risks and the opportunities, and then give you actionable suggestions to align with your goals. And again, I'm not selling anything here. I'm going to be using the data to research investor behavior, so you're going to be helping other investors as well, but I will never share your data or your name with anyone. This is going to be a big project, so spots are limited here. If you want in, look for the link below and then get your free one-on-one. Back to that news though, and the first one we're talking about here, this acquisition target. So shares of CyberArk software jumped 15% when Palo Alto Networks, that's ticker PANW, would acquire it for $25 billion. There's still a 20% upside to the price tag. Okay, right now it's trading for a market cap of just $20.5 billion. Obviously, the market isn't quite sure if this is going to close or not, the $25 billion price tag on it, so it's trading a little bit under there. Now, I'm not suggesting buy CyberArk. What I am suggesting is that this news leads to an acquisition of another cybersecurity stock we're following. I do like Palo Alto. It is the giant within cybersecurity right now, $115 billion. It is the largest company and really a foot in the door of every segment of cybersecurity that we follow. I'm going to be talking about those segments, kind of the segment growth rates, but really what drove this acquisition was growth. And Palo Alto, when you get to be a $114 billion company, you kind of start slowing down some of that growth. Okay, here we see the analyst forecast for Palo Alto. We can see here in 2025, analysts have just 14% growth penciled into $9 billion here for Palo Alto. So what it's seeing is it's kind of slowing down with some of the segments it's in, and we'll show you what segments Palo Alto as well as CyberArk is in a little bit here. But that growth is slowing. That 14% growth isn't much compared to some of the other cybersecurity stocks that I'll show you and that we follow, growth of 20 and 30% sales growth each year. So Palo Alto felt that it needed to buy that growth in a very specific segment that we're going to look at. So it went to CyberArk Software to buy that growth. Here we see it did sign for a $25 billion deal, and we're seeing a lot of those acquisitions start to come up in cybersecurity. Again, it's my favorite growth theme. I'm going to show you the growth in there. Growth overall in the industry, cybersecurity industry, is supposed to be about 12% over the next few years. We're seeing even stronger growth in some of the specific sectors, which is why it targeted CyberArk right here. Now, where we get to that acquisition idea here is that CyberArk is what's called the identity access management segment of cybersecurity. Okay, so when you go into a website, it identifies or it verifies your identity, right? Very important. Obviously, it's that first layer of defense for cybersecurity. CyberArk says here counts more than 10,000 customers globally, according to its website. That's going to be very important for the stock that we're watching for the stock that I think could be the next acquisition target. That's because if we look here at the segment growth within cybersecurity, so these are the different types of cybersecurity, the different segments within it, even though that overall industry is looking at about a 12% annualized growth over the next several years, then the segments are not the same. Okay, these different points of security within cyberspace, within cybersecurity. Okay, so you've got some of the fast growers here: cloud security up to 18% growth. You've got SASE, secure access at the edge. Okay, that's up to 16%. Here in this identity and access management, you've got a pretty modest 9 to 12% growth, year-over-year growth in sales. Now that's not bad. It's a hell of a lot better than firewall and on-premise hardware, which is only growing at 3 to 5%. but it is kind of modest growth compared to some of these other ones. That's where CyberArk plays. That's where CyberArk, according to Palo Alto, has a competitive advantage, and that's why I bought it, to buy that 9 to 12% annualized growth and add on those customers. But then why I really like this theme is if we look at the major players in cybersecurity, okay, there are a lot of firms that do cybersecurity, but there's really only about 6 or 7 with any real scale to really move the needle in a company's performance, in a company's sales. Okay, you've got Cloudflare here, ticker NET. You've got CrowdStrike, CRWD, Fortinet, FTNT, Okta, OKTA, Palo Alto Networks, PANW. SentinelOne is kind of a small one, but one I've watched for a while, and Zscaler, ticker ZS there. And if you look into the segments within which these play, okay, you've got the little green checkbox there. That's a segment within which these companies play. And then you've got the little trophy there for one that kind of dominates, right? And if you look here in identity and access management across there, really the only 2 players in that space are Okta and Palo Alto Networks. Okay, Palo Alto already had some identity and access management products that it did offer. It's going to enlarge that with this CyberArk acquisition. But really, we see the dominance here is in Okta, and there's really no other players. Okay, that 9 to 12% modest revenue growth really means there's not a whole lot of competition going after this. Okay, the margin's a little bit slower, the revenue growth is a little bit slower. So a lot of these companies just haven't paid attention to identity and access management, and I think that is creating a real opportunity here. That's because here, if we look at some of the stats behind Okta, we can see that while CyberArk does have a good position within that identity and access management, Okta is the clear leader with over 19,450 customers. Okay, almost twice the number of customers we saw with CyberArk, and we saw that price tag of $25 billion for that. We're going to come back to that price tag, really get to value these Okta customers and see that it's actually a better deal and why it makes this company a takeover target. So it comes down to that idea that Okta does just one thing, and it does it really well. Okay, it's got a single unified identity solution for both enterprise and development customers. It's really building in the AI agents into its product. The best part here is, besides that 12% annualized growth within the company and the potential for 9 to 12% annualized within the segment, most of this is subscription revenue, which is extremely sticky. Okay, it signs people up into that identity access and management product, and then they stick around and pay that year-over-year subscription for that service. But here's where I want to put 2 and 2 together. Okay, I want to look at the analysis for Okta. I want to compare it to CyberArk and see why Okta could be such a great takeover target. Okay, if we go here to the analysis tab on Yahoo Finance for Okta, we can see that it is a slower revenue growth target. Okay, 9.6%, 9.7% annualized or growth expected this year and next. This year it's expected to reach $2.86 billion in sales. Okay, if we compare that to CyberArk, we can see that this is why Palo Alto was looking to buy it. Okay, 32% growth here expected this year to $1.3 billion, 20%, slowing down a little bit to 20% next year to $1.6 billion. So Palo Alto wanted to buy that growth. Okay, obviously it needed maybe a little bit more customers in the identity and access management segment. It wanted to boost that within a segment that really there is not much competition in, but it also wanted that sales growth. Okay, if Palo Alto was only reporting maybe 12, 14% sales growth a year, it wanted to boost that with this acquisition. So we do see that Okta is a slower sales growth target, but it has almost double the sales. Okay, so again, a much larger scale and actually a higher value per customer. Okay, if we just do a back of the envelope here, we got CyberArk software here. It was $1.3 billion. $1.3 billion for 10,000 customers. That's about $133,000 per customer. Okay. Now, if we go back to here to Okta, $2.86 billion in forecasted sales for this year, has about 19,500 customers. That is an average of $147,000 per customer. Okay. So we do see that while Okta has that slower sales growth, its customers are worth more. Its customers are worth quite a bit more here on average. And I think that's just because it is the leader, the dominant player here in this identity and access management. Now, here's where it gets interesting, though. If we go here to the statistics, we can kind of do a back of the envelope calculation on, how much Palo Alto is paying for these customers for CyberArk software, and how much another company could pay for Okta, because again, there really isn't much competition in that identity and access management. And even though it is only growing 9 to 12% growth per year, it's not bad growth. It's solid double-digit growth. And when you're a cybersecurity firm, especially one, like Palo Alto, like CrowdStrike, that's trying to put in an all-in-one package for your enterprise clients, you need every segment. Okay, it doesn't matter that firewall is only growing at 3 to 5% a year. If you don't have that firewall product, your customers are going to have to tack that on through another vendor, okay? And, who's to say if they don't go to this other vendor and the other vendor says, well, hell, we got firewall, but we also got everything else you need. So why don't you move all your business to us? Okay, so that's what we're seeing, this consolidation in cybersecurity. Is we're seeing these companies try to put together an all-in-one platform that serves all their needs. That is why this is so important to have this identity and access management, where really up until now, there was really very little competition in here. So if we do go here to the statistics, we can see right now, CyberArk software trading for about 16 times on a price to sales basis. That is trailing sales though. If we actually do the math here, we can, and we do the math, it's CyberArk. So Palo Alto is paying $25 billion for CyberArk, which is expected to reach about $1.3 billion in sales this year. That means about a 19 times on a price to sales basis. Okay, that is much higher than the price to sales that it's traded at over the last year. It's a premium. You usually see that in an acquisition or a takeover, they're going to pay a premium on what the company has traded in the past. But then when you compare that to the Okta stats, even on this lower growth expected, Okta is a steal at 5.9 times on that price to sales. Okay, $2.86 billion in sales. Right now trading for about $16 billion. So 16 divided by 2.86, it's about 5.6 times price to sales compared to that 19 times price valuation that Palo Alto offered to buy CyberArk. Okay, so even if somebody were to come in, look at Okta, say, hey, this company has 20,000 customers, in this identity access management, 20,000 customers that we can, not only get a play in this IAM segment, so not only be able to offer that product to our own customers, but we can also bring in those 20,000 customers and cross-sell them across our entire platform. Okay, and they're more valuable customers than Palo Alto got with CyberArk anyway. Okay, so even if we only say maybe 10 times price to sales, okay, we can see that there's no way in hell that somebody is going to offer 19 times price to sales for Okta when it's only traded for maybe 7.5, 6.5 price to sales at its peak in the past year. So, but if we say, okay, we are going to offer a premium for the shares, we offer 10 times that price to sales ratio. So 10 times the $2.86 billion in sales expected this year. That would be about a $28.6 billion market cap. We take that by the $16 billion that the company is trading at right now, and we get a 78% return potential. Okay, 78%. That would be times 91.11. That would be about $162 share price. Okay, not saying that it gets all the way up there, not saying that they get that kind of an offer in an acquisition. But what I am saying is this is a very, almost an obvious acquisition target, okay, to tack on that IAM, that's identity access management segment onto another company's portfolio of products there that is very cheap compared to what Palo Alto just paid for CyberArk for half the customers and a less valuable customer as well. Even without that acquisition, though, going to some of the stats that I put together for a recent cybersecurity video here, we can see this Okta here, OKTA, trading for, at that time, about $17.3 billion market cap. Revenue growth of around 9.7%. So not the highest revenue growth. In fact, it is the lowest revenue growth within the 7 stocks here. 10% revenue growth isn't bad, but for cybersecurity, it's kind of slow. Operating margin is solid here, though. When you've got a segment or an industry that typically has negative operating margin, so negative profitability, because a lot of these companies are reinvesting so heavily into research and development back into the business, they've got negative profits there. But Okta is posting positive profitability, so that's going to be very attractive to some of these companies. And then on the price to earnings basis, it is the cheapest among these 7 stocks here. Okay, so 35 times on a price to earnings basis. Adjusted for its growth, for its earnings growth, only 2.7 times. So here you've got a dirt cheap company that is profitable and that is a very valuable target to some of these other companies. Nation, this is the kind of 2 and 2 math that you need to be doing, because basically everyone is looking at the same numbers and the same estimates put together by analysts that honestly couldn't forecast the weather standing outside. I worked as an analyst, worked for more than 10 years of venture capital and equity analysis, and they do an insane amount of work. Okay, I remember what we always used to call the Bloomberg bump, okay, a combination of Red Bull and Ritalin that was popular among analysts when you're putting in those 100-hour work weeks around earnings season. Okay, going blind on cash flow modeling. They put in the time, but even that level of analysis, it comes down to the fact that you're still really only looking at the same company numbers as everyone else. And that's why you see analysts just chasing stocks higher or lower, even chasing the overall index. Here we see the price targets for the S&P 500 at the end of this year. So 2025 level targets, year-end targets. First, before the Liberation Day, the tariff scare, everybody was saying, okay, the S&P 500, it's gonna reach 6,500, 7,100, would have been about a 10 to 15% return. When that tariff scare hit, everybody rushed to downgrade their estimates. Of course, after the fact, after investors had already lost a lot of money, and then analysts were just chasing themselves, trying to lower their estimates. Of course, when that tariff scare blew over, then they jumped back up. Okay, you get forecasts like this where everybody is doing a lot of work, but they're just looking at the same numbers. They're reacting to the same data. You cannot react. You have to be proactive, putting two and two and these news stories together. So again, nation, you will not beat the market by looking at the same numbers and expecting it to come out any different from the exact same shit souffle. Okay, you need to be taking that news, seemingly unrelated events or other news, putting it together here, like we've seen with this CyberArk acquisition, and then looking at one of the only other companies with a good product and with scale in that segment and saying, okay, you know what? Who's next to acquire Okta? Putting those together to see where the market is wrong or it's just where it's not pricing in yet. Now here, updating you on SoFi Technologies, ticker SOFI. It's been one of our best stocks. I was saying to buy this in 2023 when it was just a $6 stock, but it has struggled over the last month. So I want to update why that is, where I think this is going. And despite what I'm going to say, this is still my sixth largest holding with over 122,000 in this one account, up 273% since we started buying it. Actually hold it in 3 other retirement accounts as well for over $250,000 in just this one stock. Despite that, I do think it is going to struggle here in the low 20s, $22, $23 for a while and probably sideways at best. Now, I do have to give management all the credit in the world for just a continuing amazing growth here, building an all-in-one super app for financial services, carrying on that amazing growth, 34% annualized growth in members to 846,000. 44% revenue growth, building out that really, again, that financial super app here. So investors looking at the growth here, forecasted by analysts, 17 analysts covering this target, have a forecast of $3.4 billion for this year, 31% revenue growth, slowing down a little bit to 22% next year. But compared to some of your other some of your other banks, this is amazing growth. And that's why it has gone that 273% since we started buying it. But then if we look at the statistics here, the valuation on this, that's where we run into trouble. And that's why I think this is going to go sideways at best for a while until it catches up. They're using that reason, that 31% annualized growth in revenue to justify this 3.85 times price to book value. Now remember, price to book, that's the term, or that's the measure you want to use for SoFi and really any bank stocks. Those banks, they carry their liabilities and their assets on the balance sheet at pretty much market value or face value. So it's a very good measure of the actual worth, the book value of all their assets and minus liabilities. So that's what you want to use for a bank stock to do the valuation instead of the price to sales, which we use for a lot of the growth and the tech stocks, or the price to earnings, which is a little bit more common you hear in the market. So 3.85 times price to book. And if you look at some of these other banks, on that growth, I would be willing to pay maybe 1.7 or 2 times price to book for this, because it is a very strong growth stock. It does have that financial super app, but there has got to be a limit here, folks. When you compare SoFi to other bank stocks here, you can see why it does have a premium on those shares, why it is trading so high, 3.85 times price to book, 6% revenue growth here for Bank of America. That is pretty typical of most of these banks. Capital One, you've got Bank of America, you've got some of the regional banks there. 6% revenue growth is about normal for that. So when you get a company growing at 30% revenue, obviously it's going to trade as a growth stock at a premium. You look here at the statistics for Bank of America, but trading at 1.2 times, 1.16 right around 1.1, 1.2 times price to book. So a third as expensive on that price to book basis as SoFi. So yes, on that 31% revenue growth, 22% plus next year, there is some premium justified for SoFi. But in the end, when it does just come back down to it, and when it does become the mega bank that I said it would become years ago, it's still just a bank stock, folks, and that valuation is very stretched. So that's where we are on SoFi. I'm still holding most of my position. I've actually started taking some profits, selling some call options against the position, so taking some of the risk off the table because, again, that best case scenario, I believe, for SoFi trades basically flat for a while its book value kind of grows into that $25 billion or $27 billion market cap right now. I would consider buying any dips, but it would have to probably come down to about $15 a share or something right around there. That would be a crash for these stocks, come down to $15, $17 per share into that more reasonable price to book value area. Don't miss our Monday market update, 9 a.m. every Monday before the market opens for the stocks I'm watching this week. Check out this Monday's video here on the right. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.